Chapter 4 of the financial accounting subject is all about sources, records, and books of prime entry. In this chapter, we are going to learn about statement of financial position, statement of profit or loss, the books of prime entry, and the memorandum ledgers. We will be learning also about cash book, sales day book, purchase day book, petty cash book, and the journal book. Before we start this chapter, let us do a simple exercise to list down everything that we own and everything that we owe. The things that you own are 1. Cash, 2. Car, 3. House. What about the things that you owe? Your bank loans, loans for your house, mortgages, credit card are the things that you owe. So which means whatever is listed down as own are your assets, and whatever is listed down as you owe are your liabilities. So let us try to understand what are assets and what are liabilities. What is the definition of an asset? Asset is a resource that is controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. So let us take the example of a car here. So let us say your entity owns a car. So entity owns the car, and what does the entity will do with the car? The business will use the car for its operations. So what does this mean? If it owns the car, then it has the right to control the car. It means the entity decides for what and the purpose for which the car will be used. So entity gets to decide for what purpose and when the car will get to be used. So that is called as control. The entity will decide whether I need to run the car, not run the car, whether I need to use the car for the time being or not use the car, keep it aside. That is called ultimate control. It's basically because of a past event. You own the car, which means you would have purchased the car on a past date, right? So you own the car because of you have paid for it on a previous date, and you get future economic benefits. What are future economic benefits? Generally, you get a benefit when you are using the car for the business purposes and you earn revenue out of it. So let's say that you use the car in the business, which means you can do business in a better way. You can easily reach customers. You can drop off the things in a much better way. You can reach the delivery points in a faster way. You can use the car in a way that you would gain a lot of value from it. So any benefit which is monetary in nature you gain by using the car in your business is an economic benefit. So by using the car for business, you either gain money or revenue, or you reduce expenses, thereby increasing your profit. So when these three events are present, that is control, past event, and future economic benefit, which means these are an asset. So if all the three is present, you control the car. If the car was purchased because of a past event and you gain benefit out of by using the car, this car would be recorded as an asset. What about liabilities? So let us say, in terms of, let us look at the definition of a liability. Liability is a present obligation of the entity arising from past event, the settlement of which is expected to outflow of economic benefits. So it's the straight opposite of an asset. So let us say you purchase this car using a car loan. So purchased car by car loan. Now what do you owe? You owe the bank X amount of value for the loan that you have taken. So what does it mean? So you will either settle, you have an obligation now. What is the obligation? You have a present obligation, which is the amount for which loan is taken, where you need to pay back the money, pay back the amount of loan to lender, right? And again, it's because of a past event. You purchased the car, you bought the car and you took a loan, and that's why you have this event. So it's because of a past event. And also settlement will be by the basis of outflow of economic benefits. So you will settle this particular loan amount only by either paying cash or giving back the car. So by either ways, you are losing certain amount of money, economic benefit out of your company. So when these three are present, then this is a liability. Liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow of economic benefits. Asset is a resource controlled by the entity as a result of past event and from which future economic benefits are expected to flow. Where you purchase a car by a car loan. So the loan amount is your liability. The car itself is a asset. Because if you want to pay back the loan amount, you have to settle it either by giving back the car or settling the entire amount of loan that you have taken. And the asset, once you sell the car, you will receive certain money by selling the car, and also you will benefit by using that in your businesses. Your financial statements comprises of one, the statement of financial position, which is nothing but your balance sheet. Statement of financial position will be always written as at 31st December 2020, for example. So it is always as at a specific date. It will include all the entire life to date balances of that particular amount. Your statement of financial position would include assets, which we learned just now, where there is an item because of a past event, you own the control of that particular item and you gain future economic benefits. Your assets are divided into non-current assets and current assets. Non-current assets are those assets which you own for more than 1 year or 12 months. So any item that you own for more than 1 year, it is considered as a non-current asset. It is shown as if you own it for a longer period of time. For example, a car. Once you purchase a car, you might use the car for more than 1 year. Your buildings. all are items that you might use for more than 1 year. Your current assets are also called as your liquid assets. It's used for your liquidation. So are those items which you own for less than 1 year or less than 12 months. The examples of non-current assets are your machinery, buildings, car, etc. Current assets are examples are inventory, cash, receivables, etc. You will learn more about non-current assets and current assets in a later time. The next part of your assets, of your statement of financial position, comprises of equity or capital. Let us learn about capital. Capital is what the business owes the proprietor or owner. If you remember the last chapter, we studied about business entity concept, where you consider the owner and business to be separate. So here, when the owner invests X amount of money to the business, it is shown in your business accounts as capital. So if I start a business and I invest $100,000 into my business, it is shown in my capital account. It is the same way, it's treated similar to that of a liability. In here, the business is owing to the owner, but liability is where the business owes to a third party. So let us include capital over here in our statement of financial position. So capital, amount business owes to the owner or proprietor. You can also say that it is the amount invested by the owner to run the business. So your assets will be on one side, and then comes your equity and capital, and then comes your liability. So your equity or capital and liability will be on one side, and your assets are on the other side. Your total assets, and then comes your equity and capital, and then comes your liability. So what we learned about liability is the obligation, a present obligation which arises because of a past event, and the settlement of which will lead to a future economic benefit, a future economic outflow of our resources. So in liability also we have non-current liability and current liability. So non-current liability more than 12 months. Current liability is a liability that you owe for less than 12 months. And your total assets will always be equal to your equity or capital plus your liability. And that is how you tally your financial position, your balance sheet. Your total asset should always be equal to your equity plus liability. Now let us learn statement of profit or loss. So a statement of profit or loss is a statement which will show all your revenue, your incomes, and the expenses that you have incurred. But unlike financial position, which is a life to date, statement of profit or loss is only for 1 year, for a period of 12 months. So your statement of profit or loss would show your incomes and expenses only for the 1 year, and the ending profit that you generate after deducting all your expenses from your income is taken into your capital as an addition, because your profit generates money which will increase your cash, and the corresponding effect, your capital will also increase because the profit is retained in the business. A statement of profit or loss for a sole trader will have the following key features. Headed up with the period for which the income expenses are being included, which is generally for your accounting period, which we learned. The top part is the trading account, which records sales less cost to sales to arrive at the gross profit. So what is the nature of your operations and what is the money that you generate out of the operations is what your trading account talks about. Let us say I am a shoe manufacturer. I manufacture shoes and I sell shoes. That is my revenue. And what are the expenses that I incur because I am manufacturing and selling the shoes? That is my cost of sales. So my revenue minus the expenses I incur to manufacture the shoes and sell it, our cost of sales, the balance amount is my gross profit. My gross profit is just because of how I have traded my business, how I have done my business, operated my business. So the entire amount of gross profit is because I am a shoe manufacturer and I am selling shoes and I am generated money out of selling the shoes. Other expenses which I incur, like for example to administrate my business, my administrative expenses, my rent, electricity wages, salaries, all would be included from the gross profit to arrive the profit for the year. So let us just write down the format of the statement of profit or loss. So statement of profit or loss, which will always be for the year ended 31st December 2020. So which means it is only for a period of 12 months. So I should include only the income that I have generated over the past 12 months and the expenses I have incurred for the past 12 months. So my statement of profit or loss will start from revenue. And what is revenue? Revenue are the income that I generate out of my day-to-day operations. Less, I would deduct the cost of sales. Revenue minus cost of sales will give you gross profits. And any other income that you generate from your business, for example, interest income, all are shown as a separate line item. So income, you can call that as other income. Then you incur certain expenses like administration expenses, depreciation expenses. You will reduce it from your books. You will also reduce your tax. This will be your net profit before tax. You will reduce your tax. You will get your net profit for the year. This net profit for the year is added to your capital in statement of financial position. Profit is the excess of total income over your total expenditure. If expenditure exceeds income, the business has made a loss. So if you generate more revenue and your expense is lower than the revenue, you are a profit. But if you generate less revenue and you incur more expenses, you are made a loss. Your cost of sales have a formula that you need to learn, which is your opening inventory plus your purchases minus your closing inventory will give you cost of sales. So if you see, the entire cost of sales is relating to the amount of purchases that you have made, which is nothing but buying your own products, your goods, and what is the opening inventory or the products that you have, and reducing the closing inventory that you have not sold. So the entire cost of sales is relating to the sales that you have made. That's why it is called as cost of sales. So relating to sales made. That's why it's called as cost of sales. And this is what we're going to learn in the upcoming chapters. How you calculate your cost of sales, what is an inventory, what are closing inventory, purchases, etc. But for the time being, just remember this concept. Your cost of sales would include your opening inventory plus purchases minus your closing inventory. And the entire amount of cost of sales are relating or matching to the revenue that you have made. The statement of profit or loss is a summary of the business performance over a period of